The global financial system is often portrayed as efficient, modern, and fair. But beneath the glossy surface lies a powerful engine, a debt machine that binds nations, shapes policy, and determines lives. In this video, we are going to examine how debt, sovereign debt, external debt, structural debt, has become a tool of control, allowing major economic players to exert influence over smaller ones and, by extension, influencing the everyday lives of billions of people. Let's start by defining what we mean by debt machine. At its heart, it is the mechanism by which money is lent, interest accrued, and payments perpetuated. Unlike a one-time loan, debt often entangles nations in a cycle. Borrow, pay interest, borrow more to service existing obligations, facing further constraints. The system involves multiple actors: sovereign governments, international financial institutions, private creditors, banks, markets. For example, the international data show that global debt remains elevated at over 235% of world GDP. This means that across all nations, the combined public, private, and corporate debts amount to more than twice the world's economic output. Such immense totals cannot simply be repaid without consequences. Something gives. What does this mean for nations? In practice, it means that policymakers are constrained. Countries must allocate large portions of their revenue to servicing debt, interest payments, and principal amortization. That reduces fiscal space for education, health, infrastructure, social welfare. In many cases, the terms of borrowing include conditions: structural reform, liberalization, austerity. This is the mechanism of subordination. We'll explore in this video how the debt machine operates, who builds it, who maintains it, and who pays its cost. We will show how small and large nations alike are enslaved by obligations that often outstrip their capacity to repay, how global power is structured around these flows, and what it means for the future of global governance. By the end of this journey, you will understand why debt is not just a financial condition, it is a structural tool of control. You will see how the architecture of the global financial system was shaped after World War II, how the major institutions embedded rules and norms that favor certain countries, and how today's system remains skewed in favor of those who lend and less so those who borrow. Let's begin by going back in history to see how the system was built. To fully grasp the debt machine, we must go back to the historical roots of the global financial system. In the aftermath of World War II, the world powers sought to create an order to prevent economic collapse, global depression, and war. The outcome was the creation of institutions such as the International Monetary Fund, IMF, and the World Bank, anchored in the system of the US dollar and the Bretton Woods Consensus. These institutions were established to provide loans, set monetary and fiscal rules, and promote reconstruction and development. On its face, the project was noble, but the institutional architecture set a precedent. Lending becomes conditional. Currencies become anchored to major powers. Debt becomes a tool of influence. Over decades, more layers were added: bond markets, derivatives, private banks, global financial chains. The system expanded and deepened, enabling credit to flow rapidly across borders. However, as the system grew, so did the leverage and fragility. Many developing countries borrowed heavily, often denominated in foreign currencies, exposing themselves to exchange rate risk and external shocks. The debt machine thus became a two-tiered system. Developed countries with strong currencies and deep borrowing markets could absorb shocks. Developing countries, by contrast, relied on external borrowing under less favorable terms. They became vulnerable to shifts in interest rates, commodity price collapses, capital flight. For example, external debt statistics captured by the World Bank's International Debt Statistics show that many low- and middle-income countries are reporting high levels of debt stocks and flows. World Bank. And the OECD's Global Debt Report 2025 shows that sovereign and corporate borrowing continue to rise, and the maturity burden is huge. OECD. In short, the historical architecture created a machine, one that runs on borrowing, interest, currency dominance, and the fact that those who lend set the rules. The rest must comply. In the next part, we will examine how the machine works in practice, how the flows operate, and how nations become entrapped in debt. Now that we have the historical backdrop, let's dive into the anatomy of the debt machine, the flow of credit, the mechanisms of borrowing, the obligations of repayment, and the consequences of default. Understanding this anatomy is key to seeing how nations are ensnared. At its simplest, a country issues debt either domestically or externally. It receives funds, it pays interest, and amortizes principal over time. If growth is strong, the debt burden can be managed or reduced relative to GDP. But if growth falters, interest rates rise, currency weakens, then repayment becomes more expensive in local currency terms, and the burden increases. In many cases, debt is denominated in foreign currency, e.g. US dollars or euros. Thus, if the local currency falls, debt servicing costs jump. This creates a dependency on external flows, foreign investor confidence, and the global cycle of credit. The debt machine also uses leverage and maturity structures, short-term bonds, expensive rollovers, and increasing interest outlays. The recent Global Debt Report warns that many sovereign and corporate debts are maturing in the next 3 years, heightening refinancing risk. What are the consequences? For indebted nations, large interest payments mean less room for investment in infrastructure, education, health. Debt may force governments to adopt structural reforms under conditionalities imposed by lenders or institutions. In effect, sovereignty is compromised. Moreover, the debt machine uses power asymmetries. Creditor nations, institutions, and markets have the upper hand. When a debtor country struggles, negotiations may lead to austerity, privatization, opening of markets, and other conditions favorable to lenders. Some call this debt trap diplomacy. The machine is designed to maintain flows from debtor to creditor, often benefiting the creditor at cost to the debtor. We also inherit the risk of a debt spiral, borrowing to refinance existing debt, interest accumulation, currency weakness, further borrowing. The system becomes self-sustaining and difficult to escape. Next, we will look at how the machine plays out in specific types of countries: advanced economies, emerging markets, and low-income countries. To see the debt machine in motion, it helps to examine case studies and identify recurring patterns. Let's look at how different nations become entrapped and what common signals appear. First, many indebted nations experience modest growth or stagnation while debt servicing costs rise. For instance, advanced economies may borrow heavily and manage relatively well, but emerging and low-income countries often lack the buffers. According to the IMF, public debt in emerging markets and developing economies averages under 56% of GDP, but some nations are much higher. Second, many loans carry conditions. These may require economic liberalization, privatization, removal of subsidies, and opening to foreign investment. When these conditions are enforced, domestic policy autonomy can be restricted. Thus, nations become structurally constrained. Third, external shocks. Commodity price collapse, currency depreciation, interest rate rises can amplify debt burdens. These external vulnerabilities become inherent in the debt machine. When a country cannot pay, it may go to the negotiating table and accept more debt on worse terms, or default, which often triggers new rounds of borrowing or austerity. We can observe the pattern. Phase 1, borrowing for development or crisis. Phase 2, growth stalls, servicing rises. Phase 3, borrowing to pay existing debt or restructuring. Phase 4, policy constraints, lost autonomy, and sometimes political unrest. Consider how the global data reflect this. The World Bank's international debt statistics provide detailed stocks and flows of external debt for many countries. And the OECD report shows that large fractions of debt are maturing imminently, increasing risk. What does this mean for everyday citizens? Governments under heavy debt burdens may impose austerity, cutbacks in social spending, higher taxes, slower public investment. The burden of austerity often falls on ordinary people. Moreover, the promise of debt-funded development may shift into a trap of structural dependency. In the next part, we'll examine the actors who build, maintain, and benefit from the debt machine: banks, investors, governments, institutions. We now shift focus to the actors of the debt machine. Who builds it, who profits, who enforces it. Understanding incentives is crucial to seeing why the system persists and how powerful interests shape it. The lenders include sovereign states with strong currencies, international financial institutions, IMF, World Bank, commercial banks, bond markets, investment funds. They provide credit, set terms, collect interest, and hold power to demand reforms. The borrowers include governments of all types, but especially developing and middle-income countries lacking deep domestic capital markets. Why does the system persist? Because, from the lender's perspective, it offers returns, influence, and leverage. From the debtor's perspective, it offers access to funds for infrastructure, for crisis relief, for development, which might not otherwise be available. But the devil lies in the terms and the asymmetries. Large creditors often impose conditions or expect certain openness in policy. They may favor repayment over social investment. They may benefit from privatizations, access to natural resources, or geopolitical influence. In many instances, the debt machine replicates old power structures under modern financial architecture. For example, the Paris Club of Creditor Nations negotiates terms with heavily indebted countries. China itself has emerged as a major lender to developing countries through its infrastructure diplomacy. These facts illustrate how debt links with geopolitics. We can also examine how capital markets work: sovereign bonds sold in global markets, interest payments credited to foreign investors, rating agencies influencing terms and risk. These mechanisms mean that debt servicing becomes a part of global financial flows. The machine is systemic and structural. It creates dependencies, sets rules, rewards lenders, and constrains borrowers. And so the cycle continues. In the next part, we'll explore how the debt machine affects the global hierarchy, advanced economies, emerging markets, and low-income countries differently.
Let's now look at how the debt machine plays out in different regions and types of countries. Behavior varies significantly between advanced economies, emerging markets, and low-income countries, but the mechanisms remain similar. Advanced economies. Many rich nations have high debt levels but have stronger domestic markets, strong currencies, control over their central banks, and lower external vulnerability. For example, Japan's debt-to-GDP ratio is over 200%. These nations may still be exposed, but their tools differ: domestic ownership of debt, monetary policy flexibility, deeper markets. Emerging markets. Here, the risks are higher: external debt, currency instability, capital flow reversals, high interest servicing. These countries may rely on commodity exports, foreign borrowing, and currency risk. A major shock can rapidly increase borrowing costs and debt burdens. Low-income countries. These often suffer the most. They may borrow at higher interest rates, rely on external financing, and face limited domestic capacity. Many spend more on debt servicing than on education or health. The debt machine can trap these countries in cycles of dependency. Now consider real-world implications. Citizens may see increasing taxes, reduced social spending, slower growth, or even political instability because the state lacks fiscal space. Infrastructure may be deferred, public services deteriorate, and inequality may rise. The machine thus not only affects macroeconomics, it affects human lives. Another dimension is the external shock: interest rate hikes in major economies, commodity price collapses, pandemics, climate disasters, all amplify debt servicing. Borrowers become more vulnerable. The debt machine ramps up its grip. In this environment, some countries resort to restructuring or default. The process is messy: negotiations, austerity, IMF programs, restructuring. While necessary at times, the process often comes with loss of sovereignty and economic hardship. In the next section, we will explore future scenarios. What happens if the debt machine breaks, or if it evolves, or if reforms are attempted?
Looking ahead, the debt machine faces multiple pressures and potential openings. Let's examine the future, the risks, necessary reforms, and possible escape routes for indebted nations. Risks. The foremost risk is systemic. With global debt at over 235% of world GDP, the potential for cascading debt crises grows. Another risk is refinancing. As many sovereign and corporate bonds mature, the burden of servicing may spike. Additionally, there is currency risk, interest rate risk, geopolitical risk, and climate risk. A shock in one region can propagate globally via the interconnected financial networks. To break or reform the machine, key changes are required. Sovereign debt architecture must improve. More transparency, fairer terms, better mechanisms for restructuring. Creditors and borrowers need more balanced relationships. Institutions like the IMF and World Bank must adapt. Development banks must focus less on lending, more on capacity building. Domestic policies must enhance growth, investment, and reduce dependence on borrowing. Escape strategies for nations. 1. Build domestic capital markets and reduce reliance on foreign currency borrowing. 2. Strengthen institutions, governance, and investment in productivity so that growth outpaces debt. 3. Negotiate debt restructuring proactively rather than reactively. 4. Diversify economic base to reduce external shocks. 5. Regional cooperation to share risk and build collective resilience. However, none of these strategies are easy or quick. They require long-term commitment, structural change, and often painful reforms. The machine is resilient, and the stakeholders who profit from it have strong incentives to maintain the status quo. We must recognize a key insight. The debt machine is not inevitable. It is constructed. It is maintained. Therefore, it can be reshaped, but only if the political will exists and only if societies understand what is at stake. In the next and final part, we will draw conclusions and look at what this means for you, businesses, governments, individuals. As we draw to a close, let's reflect on what we've learned. The global financial system is not neutral. It is built, designed, and maintained by powerful actors. The debt machine we've examined is not simply a byproduct of globalization. It is central to the power architecture of the modern world. For nations, large and small, the machine creates constraints, binds policy, and shapes futures. For individuals, it can translate into fewer jobs, fewer services, more austerity, higher taxes, slower growth. But it also offers opportunity. If we understand how it works, we can demand change. We can reform. We can resist complacency. What does this mean for governments and policymakers? It means acknowledging that borrowing is not free money. It means building institutions that allow borrowing to be invested productively rather than servicing alone. It means diversifying economy, stabilizing currency, building resilience. What does it mean for businesses? It means understanding the context in which you operate. High debt nations may impose reforms, volatility, policy shifts. If you invest in such countries, you must factor in risk of currency, refinancing, policy change. On the other hand, reforming nations offer opportunity for growth. What does it mean for you as an individual? It means awareness. The decisions made by global institutions and big lenders may affect job markets, inflation, taxes, government services in your region. It means advocating for transparency, fairer treaties, sustainable borrowing, and responsible governance. Final thought. The debt machine is not unbreakable, but it is resilient. It will require not just technical fixes, but political courage. It will require a rethink of how the global financial system operates. But shift it must if the future is to be more equitable, more stable, more prosperous for all. Thank you for joining this exploration of the debt machine. The more we understand, the more we are empowered. Stay curious, stay informed. Until next time on Financial Time Capsule.